section of Kotak Life's Market Outlook. Today, I'm in conversation with two of our investment experts, Hemant Khanawala, who's head of equity, and Churchill Bhatt, who's head of debt. Let me start with you, Hemant. What are your takeaways from the current year's budget?
There are three important messages from the budget, guys. First, they are focusing on growth over consolidation. They have maintained fiscal deficit at 6.4% against market expectation of 6%. They have also taken various supply-side reforms to sustain growth in the medium term. So, overall, government has prioritized growth in this budget. Second, they have prioritized investments over consumption. Going into the budget, there was an expectation that government will transfer funds to the citizens to promote consumption. However, to the contrary, they have increased capital expenditure by 24% against revenue expenditure increase of only 1%. Housing, transportation, water and sanitation are key priorities for capital. And the third point is the policy stability and transparency. So what used to happen in the past is that when the budget used to come, people used to always question the numbers. But this time, government has moved a lot of off-balance sheet items like subsidies and support given to the public and enterprises to the budget. And that's where the budget has become much more credible. Also, there are no major changes in the direct taxes. And that gives a very much stable environment for the investors to invest in the long term, which is very, very important from a country's point of view.
Thanks, Hemant.
Churchill, the markets are really worried about the bond markets, to be precise, are worried about the large government borrowing programs. What are your views on that?
So Subhashish, since the pandemic, what has happened is, it stalled the economic activities and people stopped spending. To keep the engine running, to support the recovery, governments in turn have started spending more than what they would otherwise normally spend. What that does is, it kind of puts a strain on fiscal. It's been there for last couple of years, except that last couple of years we were swimming downstream. So governments were borrowing more, but in an environment where rates were falling and central banks were majorly supportive. Now is that we're transitioning from pandemic to what I would want to dub as an endemic. The situation is different. We may well see that while the government borrowings remain large, and believe me, 14 odd lakh crores of borrowing is roughly twice as much as what 7 odd lakh crores, if I remember right, in FY20, or that the outstanding stock of Government of India debt has shot up from 60 lakh crores to projected to be around 90 lakh crores at the end of FY23. This is in addition to the fact that the state government borrowings have also gone up. So the numbers are staggering and markets are definitely not comfortable with that. But the idea is that unlike last 2 years, if we do not see a conducive rate environment, if the liquidity situations not just locally but globally also tighten, if the rates are poised to rise, and if the central bank buying support to these markets is also going to be less, then markets are naturally worried about it. It is not so much about our intent to support the government borrowing program, it is about our ability. And I think somewhere markets are a bit jittery about its own ability to absorb such large borrowing programs. Both RBI and government in their own ways are trying to, comfort the markets. But only time will tell if the three of us come together to support this borrowing program well.
Interesting. And the Global Central Bank, they have also done a bit of tightening. And what do you think will that play out on its impact on India?
So see, I think, if I were to put it in Gulzar Saab's word, is मोड़ से जाते हैं कुछ सुस्त कदम रास्ते कुछ तेज कदम राहें. See, each country is facing its own post-pandemic situation and they're strikingly different. US, UK, probably Eurozone are seeing multi-decade high inflations. The countries which are used to low single-digit 1%, 2% growth are seeing 6%, 7% inflation numbers.
7.5% in USA.
Yeah, and for a few quarters now. So initially they probably saw it and dubbed it transitory, but I think by now they're not so sure about the transitory nature of the same. And they're far too deep into their pandemic accommodative policies to feel comfortable about staying that accommodative while their own citizens are facing huge inflationary shock. So they find themselves far too way behind the curve and are trying to play catch up. Now that is scaring obviously their markets, and to some extent because at least the financial markets are globalized. If they scale back the kind of money they have printed, even we feel a bit scared, right? I mean, we've all heard about, or probably even experienced the taper tantrums of,
13.
Yep, absolutely. So that hangover is there. But even within developed markets, if you see now, there are divergences. So while both Eurozone and USA, for example, are facing very high inflation, the growth situation is starkly different. US growth looks absolutely fantastic, while Eurozone is probably struggling to see any semblance of any durable growth. And on the other hand, there are countries like China, which while the others are tightening, are facing their own domestic real estate and other sectoral issues and are probably looking forward to easing policies. So there is a lot of divergence here. And India too is in its own zone, if I may say that. So while global central banks may tighten, India will have to respond to the post-pandemic world in its own domestic fashion. The RBI has probably stated it in as many words, and rightly so.
All right, interesting. Hemant, coming to you. The FPR outflow, its effect on earnings and tapering, what do you think will happen?
See, over the last few years, we have put a lot of emphasis on FII flows because that was the main source of funding the capital markets. Now let's look at the last year's number. We have got roughly $4 billion of FII flows, and mind you, other emerging markets have seen a big outflows. When you talk of market like Taiwan, Korea, their outflows were in the range of $20 billion. India has got $4 billion. But if you break that up, actually we have got $10 billion in the primary market and $6 billion, FIs actually withdrew. But still our markets have done well. This year again, as we talk in the, 40 odd days, they again withdrew in excess of $5 billion. But our markets are still holding on. And why is that? So what has changed? So now it's a well-known story that Indians have started investing in mutual funds and equities. So if you see DIIs, that is mutual fund plus insurance companies, have invested last year $13 billion. Okay. And this year again, they've invested around $3 billion. So they are matching. Today, the SIP book of mutual fund is in the range of $1.5 billion. So a lot of domestic saving is going into equities, and which is cushioning the market against the FI outflow. So if this trend continues, then our reliance on FI outflows will reduce over the time to fund our equities. So I agree that when the global liquidity will withdraw, then FIs will take out money out because that was the product of equity, but we are able to support it from this. Other angle which is very interesting from India's viewpoint is FDI, there is foreign direct investment, which is actually, FI money comes into the portfolio, so they go into secondary market. Where FDI actually comes and invests in our country in the longer term view. And that has been averaging around $24 billion for the first 8 months for the last 5 years. And that trend continues. And that has helped us build up fair amount of Forex reserves. Today our Forex reserves are in excess of $600 billion. So when the dollar is strengthening in the world today, and a lot of emerging market currencies are feeling the pressure, we are able to manage our currency in a good band of 73 to 75, which gives stability to our currency and attracts more flows, because biggest worry of a foreign investor is volatility in the currency. So if your currency is stable in a range, they will come to you. So overall, there will be some impact when liquidity gets withdrawn, there is a strengthening in the dollar. But I think so we are having enough strength on the macro side to withstand that volatility. So overall, we are not that worried because of FI outflows as we would have been in say 10 years back. Or even if you see in March 20, what happened suddenly, there was a lot of outflow, and since the COVID was the first time, DI also took some time to react, and that's why the markets reacted very sharply. But in the last 4 months, the outflow has been as large as what we saw in March 20, but markets have held on because today, you are much more stronger at the macro level. So overall, it looks a comforting situation.
So it's reassuring.
Yeah, it is reassuring.
So this Atmanirbharta, if I may step in, of the equity markets and the focus on currency is also supported by the fact that there is a promise of a lot of inflows if and when we get included in a bond index. So that promise of inflow, which could be, to the tune of $20-30 billion initially and then probably a few billion again annually, is also keeping a lot of currency jitters away.
While on this, the MCP just now met and maintained an accommodative stance. In your opinion, what will now happen on the debt market?
See, so I think we built the premise rather well that the government is trying to push growth. Broadly means it comes at the expense of borrowing a little extra, especially from financial markets, considering that they have kind of, at least in this budget, reduced their dependence on small savings, which means more will come to markets. And the central banks are also probably in a place where they do not want to disturb the growth momentum. They probably believe it's too early, too fragile, needs a little bit more of nurturing before it becomes durable, sustainable, etc. But then financial markets are also self-fulfilling. So when markets see a large borrowing program and takes yields sharply higher,
Which we saw just now.
which just happened probably, around about budget, it tightens financial conditions. And it probably tightens far too ahead of its time. Something which not necessarily a central bank would appreciate or a country's policymakers would appreciate if they believe growth still needs a bit more support. So to compensate for markets over self-tightening of financial conditions ahead of its time, to stop or to rein in markets from taking yields far too high, far too early, the MPC in this policy gave an assurance of a delayed tightening. It said that, while probably markets are not wrong in expecting that the policy situation would normalize post-COVID, it doesn't have to happen overnight, or it doesn't have to happen now. We will take our time, we'll move in calibrated small steps, we'll probably telegraph as much of bad news, should I say normalization, not necessarily bad news, ahead of time for you to be calm and expecting what is to come your way. And that's what I think the purpose of this, or the key message of this MPC was. It took a few market participants by surprise. I won't disagree with that. It took us by surprise. But I think the intent was to tell the markets that while yields may go up, it does, or they don't need to go up disruptively. They may take its time. And the central bank and the policymakers will exercise due caution as well as diligence before doing anything which is even remotely close to market disruptive. So that's the key message of the policy. There are a few caveats around this policy. So we believe that the central bank, while it wants to support growth, and rightly so, the jury is still out on whether we need the same extent and the amount of accommodation that we needed 4 quarters back. So a reverse repo hike, which would have been probably just a formalization of an otherwise tightening that has already happened, would not be, really too much of a tightening at all. But then the central bank is refrained from doing so. How long can it do that is a matter of time. Second, we're not exactly sure about central bank's plan around the quantum of liquidity in the economy. So we have in the banking system at this point in time, around 8 odd lakh crores of liquidity. If we add the outstanding forwards position, the Forex position of the central bank, that would add probably another 3.5 lakh crores. Now this is unprecedented liquidity. We've never probably thought we'd see that. Even during Demon era, we probably didn't see more than 8 or 9. And that we knew was mostly temporary. If for too long such quantum of liquidity remains in the financial system with rates being too low and too accommodative, it is unlikely to have no impact. So I'm sure central bank has a plan around withdrawing this liquidity probably, over a period of time. And then I think somewhere we are awaiting a communication on that front. And lastly, the central bank at this point in time in its communication has informed the markets that they expect FY23 headline CPI inflation to be around 4.5%.
That was a surprise.
This is in spite of the fact that the crude oil prices, the commodity prices are
All imported.
largely beyond our control, but still all pervasive when it comes to any and every kind of price sensitivity. So somewhere market would want to see if central bank's hypothesis on the headline CPI does not pan out as it expects that to be. What would be the kind of adjustment it would make to the current policy situation? But having said that, I think in the near term, the market's jitters are quite well contained. The central bank has given enough comfort. I'm sure the budget has given enough comfort on growth, as Hemant would say. As for the government borrowing and the path of CPI, keeping our fingers crossed, we would want to believe that the central bank's path indeed comes out to be the truth. And the country does much better than some of us at least, are fearful about.
So that was reassuring, Churchill. Finally coming to you, Hemant, beyond budget. What do you think are the lookings, how do you think the earnings will pan out?
So we are at a very interesting, milestone, you might say. Now we are looking at two things rising up, both rising interest rates and rising earnings. So rising rates is a worry in the near term. So if you see, the valuations have moved almost 2 standard deviations above the long-term averages in the last 2 years because there was abundant liquidity. Now, as that liquidity gets withdrawn globally and in India, you will see valuation moving towards at least a long-term average, if not below that. So that means, there is some correction in the market just because valuations are moving down. Normally, you will see in terms of P or whatever. So that is a headwind to the market. But on the other side, the big tailwind to the equities is that earnings cycle is coming back. In the last decade, that is 2010 to 20, broadly if you take 10 years as a period, our earnings growth would have CAGR in a single digit only. So that's where if you see the equity market returns were also muted. But now, since the COVID, there has been a recovery in the margins of the Indian corporate India on various counts. Banking sector has started doing well because there were a lot of NPA issues in the last decade. Commodity companies were doing badly. That has corrected. Now, these two are large part of our indices. So when banking does well and commodities start doing well, you are seeing a big jump in earnings. So, in the last 2 years, we are already seeing earnings growth in excess of 15%. In fact, this year it will be 30%, in FY22, excess of 30%. And going forward for the next 3 years, it is estimated we can grow in north of 15% again. So we are seeing, earnings cycle coming back after a long time. And so as an equity investor, you will expect that compounding to happen because equities compound. As famous investor Warren Buffett said that markets are, voting machine in the short term, but they are weighing machine in the long run. So you need earnings to sustain markets. You can take up the valuation in the near term, but if earnings don't come, then it will not. So what we expect is that market will go through its volatility in the near term because of this correction that valuations are coming down. But investors should use that as an opportunity to add to equity allocation because earning cycle is coming back, and that is what we invest in equities for. Because valuations can go up and down depending on the market mood, but earnings will stay with us, always. So we believe, particularly in the view, Churchill mentioned on the debt market that markets are worried about bond, large borrowing program, and that's where interest rates will move up, which will mean that return from the debt markets will be somewhat lower than what we have seen in the past, which, in the falling interest rates, you get capital appreciation. In the rising interest rates, you don't get capital appreciation. You will get only the carry and something get taken away. So in that environment, we believe that equity offers you a good option against the debt. And so one should increase, but investor will have to withstand this near-term volatility because globally liquidity is getting withdrawn. Apart from that, there are two other risks investor needs to keep in mind. One is the rising oil prices and all commodity prices. And India is a net importer of commodities, particularly oil and all energy. So that will start impacting India's CAD. And so we will be able to manage our currency. But finally, as a country, we are paying more for the commodities we are importing. So that will impact the consumption pool or the savings pool of our country. So that is a real risk to us in the economic point of view. Another is the geopolitical risk. You have Russia-Ukraine crisis boiling up. China-Taiwan is always an issue. So if any of this comes up, and that can impact the risk sentiment globally, and that can again impact the equities in the near term. So these are the three risk factors for the equities, which we believe all are near term. Nothing of this plays out permanently, because it will start impacting the economies and they will correct. But overall, I think so various measures taken by the government in the last few years should pan out, and earnings cycle should come back again to reiterate. And so we are constructive on equities with a medium-term view.
Thanks, Hemant. Thank you, Churchill. Well, that was the special edition of Kotak Life's Market Outlook. We will be back as we are every month with a regular edition of Market Outlook. Thank you for watching.